Good afternoon, everyone. A very warm welcome to our webinar on pre-IPO investment strategy. Myself, Manvi Sureka, and joining me today is Mr. Raman Chhabra. Before starting, kindly note that if you have any query or feedback, you can message it to us in the Q&A section, and all your questions will be answered towards the end of the webinar. Now, I would like to welcome our speaker, Mr. Raman Chhabra, who is associated with Edelweiss since last 6 years and has an overall work experience of more than 20 years. At Edelweiss, he is accountable for alternate investment portfolios and portfolio management funds. Now, without further delay, I would request Mr. Raman to take it further.
Thank you, Manvi, and very good afternoon to all of you for joining in into this webinar on a Saturday afternoon. I hope all of you and your families are doing safe and taking care of yourself, in this pandemic. As the topic suggests today, that we are here today to talk about the pre-IPO investment strategy. Today, I'll be talking about alternate investment funds, which are available as a strategy for ultra HNI and HNI clients. Just to give you a little brief before I actually go into the product to understand in terms of the alternate investments, what is important to understand, like most of you would be making investments across the various instruments which are available in the market, could be direct equity, you could be using the small case, you could be using, the mutual fund route or the portfolio management services. Similarly, there is an opportunity available to invest for ultra HNI and HNI clients where the minimum ticket for the investment is 1 crore and above. And they are specialized services, they are specialized categories or strategies which are available across. So SEBI allows, investors to invest, and there are three categories of fund are allowed to be raised, in the alternate investment strategy, category 1, 2, and 3. So the one strategy which we are talking about today is a category 2, in the AIF strategy, where it is normally from your perspective, what is important to understand that this is a pass-through, income where all the fund taxes only the TDS in at the fund level. Rest everything is passed on to the clients. And if you have any questions, we will take those Q&As at the end of the session. Talking about the strategy on the pre-IPO, some of you might be aware or might already be, looking at investing in the unlisted. So listed is something which all of us are fully aware of. There is opportunities which have opened up at the retail and at the HNI levels in the last few years in the unlisted side, okay, which is available. Here we are talking about a strategy, a fund manager who runs that strategy in the unlisted side of it, okay. And I'll share my screen, Manu, if you can just confirm the screen is visible to everyone.
It's loading. Yes, your screen is visible now.
Great. So as I said, the name of the strategy is, Edelweiss Crossover Opportunities Fund. So what is important to understand, and the name says crossover, and the crossover is crossing the line from the listed side of the businesses, because all your investments currently in the equity market will be in the listed side of the business. This fund provides an opportunity for the investors to come into the unlisted side in a structured way. And the series we're talking about currently is series 3B. This will give a little background of the history on this strategy. At Edelweiss, we've been doing this strategy from November of 2017 when we launched our series 1. We've done series 1, series 2. We came up with series 3 in last year, May of 2021. And then we closed that in the month of July. We came up with series 3A, and that got closed in December. And now we are in series 3B, which is there for us. So at a fund level, for us, series 3, 3A, and 3B are one strategy as together. But these are close-ended funds where only 999 clients can be allowed to be participating in one series. That's the reason we call this as series 3B. Okay. Taking it further, what the opportunity is, my request to all the participants in this webinar is that, normally as an asset class, we make our investments in 4 separate asset class, which is your equity, your debt, your metals, which is gold or silver, or diamonds, or real estate. My request to you is there are 2 more asset classes which are currently there. One is cryptocurrency, people are talking about, and this one, which is the unlisted market, consider as a separate asset class for you when you look at it from your overall perspective or a portfolio allocation perspective. Okay, why we believe at Edelweiss that this is important? Just to give a little brief, and I'll talk about in detail. When you compare your Nifty performance with the IPO index performance in last 10 years, clearly there's a 9% of an alpha which is there, which makes us interested in why this market is a very attractive investment opportunity for us. Also, that IPO supply, 25% plus of it is being right now funded through the private equity route. Okay, and then we'll cover these points in detail. So important to understand. Again, important point to understand why you should look at this strategy, because here you are trying to buy something in the unlisted and hold on to that investment and have it sell it out at the listing side of it. And the discounts could be from a 20% to 70-75% to the IPO pricing. That's one thing which we think is very, very important, and clients need to understand why they should look at considering this opportunity for this. It's a short term, because though it's a tenure of the fund is 5 years, but when we look at it from an investment to investment perspective, we are able to do the exits in about 3.5 years, for a specific investment into a company. And in total, we've raised about 4,000 plus crores of money. Capital has been raised in this strategy. And our series 1, which is going to get closed in May of this year, is about 23% of an IRR return. And series 2 is at 40% of the IRR return currently. And we're looking at that exiting the close of the fund by July of next year. Moving forward in terms of why we believe that IPO, is an attractive investment opportunity, I'm sure a lot of you will have would be looking at, the way the market has performed in last 1 year, the amount of IPOs have come in. You would have tried, a lot of us would have applied. One big challenge, which normally we feel as a client, is that, getting the allocation, and how that problem also gets resolved by this strategy. We'll cover that in. So coming in terms of performance, as I said, from April of 2011 to April of 2021, we've looked at the Nifty performance. And when you look at my Nifty would have given me a rolling return of 10.7% CAGR versus my S&P BSE IPO index would have given me a 19.7% kind of a CAGR, clearly a 9%, alpha, which is there when I compare it. And that gap has been increasing from 2015 onwards. Okay. And especially in the last about 18 to 24 months, we've seen that gap has been increasing. And so that's the reason we believe, I think it's a great opportunity to consider as part of your portfolio allocation. Very importantly, to understand that a lot of new sectors have emerged in the economy in the last about 5 to 10 years. We have just named a few here on the left-hand side. When you look at the consumer retail, market infrastructure, technology, AMCs, manufacturing, insurance companies, healthcare diagnostics. And these are some of the examples which have come in. If you would have got these IPOs and would have stayed invested in this, the amount of what we're trying to highlight is the IRR you could make in this sector if you get good companies, versus, the Nifty return overall basis. So clearly why we say that this is a great opportunity to consider because of the high growth sectors which are available currently in the economy. Again, what we've done is we've looked at the IPOs which have come in last about 10 years, about 180 odd IPOs which came in. Does all IPO make money? And the answer is no. What we've done is we've divided them into 25 tiers each. The top 25, 25, 50, 50, 75, and bottom 25. Now, if you see that if you get an allocation, in the top 25 tier company, you would probably end up making a 60-65% kind of a gain on the listing day itself. Okay, which drastically goes down if you go to the next tier to 16%, but you're still making money off it. But bottom 50, so 52, 75, and 75 and below, you are actually going to make no money or probably lose your capital. Okay, and we've had examples in the last year or so, but most people made money, but some of them have lost. What we want to highlight is selection becomes a very, very important criteria that which companies to select. Now, important challenge which also is there in the same time is if it's a good company, you're able to get that information that covers the company. Chances of getting allocation is a problem, and we will cover that. What it also says is if you actually, normally the clients consider IPO as a event-based phenomena. And what we're saying is that actually, if you can look at it outside of the event-based phenomena, that it's not a one-time event, if you actually hold on to that investment for a 12-month period, that 63% return can actually go up to about 100% plus kind of a return for you. And this, in the second tier also, what I was getting at 16 will end up at a 50% kind of a return. So not only getting access is important, but at the same time, holding on to that, investment and getting good companies and making sure when to exit also is very, very important to consider from a long-term perspective. Mr. Shetty, I see your hand, but what we'll do the Q&A at the end of the section once we complete the presentation. If that be all right. Thank you. Now, again, I think something which everybody would have seen and known that we've seen the frenzy in the market in last year on the IPO side. We saw something similar in 17, 18, 19 was a little subdued. Last year, 2021, about 121 lakh crores was raised to the primary capital in the IPO market. And that's a substantial number, when we look at it and we see that trend to continue. Now, very important to see from these graph perspective that The light blue actually talks about my net FI money coming in. The net money which is coming in through the FI route in the capital, in the equity capital, and which we all see that the movement of FI coming in going out has a direct impact on the equity side of it. Also, to look at simultaneously, the dark blue actually talks about the money coming through the private equity route. Now, if you see from 18 to 21, the trend is the money, it is on a very high growth trend, on the private equity side. There are currently about 50 plus private equity players who operate in the country. Most of these as the funds, are raising money internationally and bringing in that capital here to make investments in the future companies, as we say. Last year itself, my net FI money was about 9.6 lakh crore. Against that, the private equity route was about 16.4 lakh crore. So that shows the interest at where fund believes in the private equity route to come early, stay invested in the companies which are future growth companies, and write the benefit of the valuations here. Okay, and that is what is important to see from a client perspective. India growth story, we've all been hearing there could be a delay of a year or so, but we are very clear that next 10 years are very important years from the growth story in terms of India. In terms of the GDP capital, we are already about 2.8, 2.9 billion capital, and we expect, by 2025, 26, we should touch the 5 trillion economy, and by end of 2030, the decade, about 8 trillion plus. So clearly that there's a lot of capital required, in terms of it, and that's the growth opportunity which is there for India as a company. That is on one side as a country and to look at it. And the second side is the deleveraging, what we've seen in the economy from what the debt to equity ratio was earlier from 90s, on this 20,000 non-financial companies. The people have understood that, raising equity is better than trying to be over leveraged, and it puts stresses. And we've seen the amount of stresses businesses had during the, COVID scenarios, in last couple of years. We've seen the impact of that. The companies who had better debt to equity ratio were able to manage it, in terms of their operational expenses and then managing the businesses better. Okay. Why we say that was on the opportunity on the IPO side of it. Why we say the late stage private equity or pre-IPO is the most attractive way. But there's a favorable risk reward from the client perspective. It is relatively less crowded space, and there's more acceptance right now. When we came up with the strategy in 17, 18, it was a strategy, but today it's a proven strategy where we have seen that, a lot of interest has come in, a lot of new players have come in, in this market. Okay. This is a very important slide for all of you to understand, to look at it. What we are saying is primarily this strategy is looking at investing in companies which are coming into the IPOs in next 2 years. Okay. What we have seen with our experience in our strategy 1 and 2, that farther I am from the distance between my IPO date to the date of my deal, farther I am, my discounts are as high as 70-75% if I'm able to look at deals between 24 to 36 months. And as I'm coming closer to it, my discounts starts to go down to about 49% in a 12 to 24 month deal, about 30% in 3 to 12 months, and it can go down to 2% 0 to 3. Am I going to look at this side? Absolutely, we are open to it. If it's a great company, we think that the future prospects are high, we might even look at investing even here. But our core focus of the fund is to identify early, stay invested, work with the company as an active investor, and reap the benefit by getting them early at a discounted price. That is where the core of the portfolio for crossover would be. Okay. Again, talking about the marketplace, as I said, this is not a private equity fund. This is not a fund because there are various stages of funding. I've been seeing the Shark Tank series, which is there in India now. I've seen the US versions earlier, and a lot of money, has been raised. This is the journey of a company here. Look at it from that perspective. This is the growth journey of a company, and we're saying when they are raising various series of funding, we are not looking at those companies. Okay. There are 50 plus equity players. There's high amount of capital. I told you about 16 lakh crore, which came in last year, is all here. There's a high supply of capital available. When it gets to the listing side of it, a lot of retail participation is available. Mutual funds come into the picture. Again, a high supply of capital available. This journey, from the time the company wants to go into the listed to the time it gets listed is about a 24 to 30 months of journey. Okay. And what is important to understand that private equity has these funds have about 7 to 8 years of shelf life of the fund. So they always are looking at the exit in this part of it. And we as a fund are looking at investing only in this the companies which are in this various stages of journey into the IPO. Currently, there are 3 to 4 active funds which are actively there. This is an illiquid. There is an illiquid risk which is there, but we are okay to continue with it because there's low supply of capital, and because of the opportunity being available, we are able to identify good companies, and we're looking at about 12 to 15 companies in our portfolio, which we stay invest, which could be my late stage to pre-IPO, and we are okay to hold on to that investment to the listed side of it. That's where the low supply of capital, and this is the marketplace which we are looking at, which is relatively less crowded for us. Coming in terms of what has also shifted is, the amount of deals which are happening in the pre-IPO to the IPO stage. Okay, what we've seen a trend from 19 onwards is that a lot of deals are happening in the pre-IPO stage only. And last year, then let's look at 2020 and 2021, about 50% of the IPO deals were actually done in the pre-IPO stage, which means what? If there are 30 IPOs coming in the market, 50% of that were actually already subscribed in the pre-IPO stage itself, either through an anchor or through a fund or an institutional buyer. Okay, and that is what the trend has continued in 2021 also. Now, importantly, looking at why we say that crossover fund, which we've been talking about, earlier it was a strategy which we believed in. Today we have shown and demonstrated, to all our clients in Series 1 and Series 2 that why we believe in that strategy, what expertise we brought in, and by investing early, how we've been able to generate the returns for us. Okay, and we'll just talk about our fund now. This has the three pillars what we had initiated, created for our Series 1 and Series 2, and this continues to be there as pillars for the value creation for our clients, which is selection, access, and risk management. As I said to you, selection is very, very important. Let me just come here. So selection, why are we saying selection? As I said to you earlier, when I was talking about the top 25 or top 25 to 50, if you're able to select the right company and stay invested, you could see the difference between IPO listing to the 1 year listing. So getting good quality portfolio, 12 to 15 companies in our portfolio, getting them right, they could be market leaders now, or they are the potential to be market leaders in the future. That is what the core strategy is about, selecting. Now, as I said, access, from access is that, here, because of our current existing relationship with all the private equity players in the market and the promoters, which already exists, we are able to get access. And I'll talk about some numbers in the future slide, and the risk management also, how we are able to manage the risk from the perspective of the overall portfolio, as well as from the client perspective. Why I said in the beginning is that you have to keep in perspective, this is a separate asset class for you. And I'll talk about it, in the future slides, and how we were able to balance it out, in the volatile market for our clients who were invested with Series 1 and Series 2 for us. Okay, this is the performance, and I think this everybody would be interested to know in terms of our Series 1 and Series 2. Series 1 was launched in November of 2017, and Series 2 came in September of 2018. As on 31st of December, my performance in terms of the fund performance for Series 1 is about 23%, and Series 2 is about 40.5%. This fund is going to get closed by May of 2022, this year. And this fund will be looking at closing in the mid of sometime next year. Important to understand that though we might be looking at doing the fund closure by May of 2022, but on a crore of capital, 1.10 crore has already been paid back to our investors already. And they still have 50-60 lakhs rupees of investment, which are still pending in the fund, which will be executed and liquidated. These investments will be liquidated in the next about few months or so, and will be paid back to the clients. On my crossover 2 strategy, where on a crore, we've already paid about 60 to 70 lakhs to our clients, and the balance will be paid. Substantial amount will get paid by end of this year, and by next year we're looking at closing this fund. So this is the strategy in terms of the history, past performances for our Series 1 and Series 2. I talked to you about risk management. Very, very important to understand. Like, we saw what happened to us a few days back in the market when the market, there was volatility, or even in the March of 2020, when the COVID wave hit first time for us. All our clients, and you'll probably be able to relate to it better. Crossover 1 and crossover 2, when you look at it, all our clients, who had, and all of us who also had a portfolio in the equity side, our portfolios in the March of 2020 was down from a 10% to 50%, depending upon what is the exposure I have in the listed, in my large cap, mid cap, and small cap. So if it was my more focus is on the large cap, probably my crore was down to about 10-20 lakh rupees versus a 40-50 lakh money, which was I've lost the capital because of the volatility in the mid cap and small cap. So a crore invested in the equity side of the market was down from a 50 to 90 lakh kind of a capital was there. Against the crore which was invested in crossover 1 and 2, my clients are down by only 5% here and at 3% here, which means your capital was down only by 5 to 3% here. Now that is what is important to understand from balancing your portfolio. How you're able to balance the risk of the portfolio from that perspective. I said to you about selection is important. What we've seen, median listing gain was about 4% in the IPO market. The companies which we picked in the crossover strategy were able to give me a 14% kind of a return on the listing side. Clearly a 10% gains which were there on the median which is there. Again, when you continue to hold on that, it became 31% for the market versus the 35%. So clearly, if you're able to get the companies right and you continue to stay invested in them, the chances of you making good money is higher as compared to the earlier situation. That is what we've been trying to highlight here. And on the access side, again, you might say that, okay, Raman, I want to put a crore rupees in a company which is very good, but getting allocation, in terms of getting allocation, what we're trying to highlight is between Amber, CAMS, Polycab, and Affle, all these were our portfolios in Series 1 and Series 2. To get a 1 crore of allocation in the pre-IPO in Amber or CAMS, a client would have to put in an application of 519 times, like 519 crores of application amount would have given us a 1 crore of allocation in the portfolio, or 112 crores in the CAMS would have given me 1 crore. So again, and you might have that kind of leverage be available to some people, but not many exercise it. But through this fund, the clients were able to get access, in all these companies, of crore, between a 5 to 10% kind of allocation was given to all our clients in this strategy. So access is how we managed to look at it from perspective. Coming in terms of, what are the fundamental biases for us while making a decision which companies to invest in? There are three fundamental biases we keep in perspective. One is my thematic bias. So I am looking at only the growing sectors of the Indian economy. We as a fund, when the fund manager is evaluating the companies, looking at all the growing sectors. Now, it could be my sector which is there and has been performing well. I'm open to look at it. Okay. What is important to understand is that structural growth opportunity has to be there for 5+ years. So that tomorrow, when I'm looking at exiting my investment, now that the whole thing, the deal is buy unlisted, work with the company in this journey of getting them into the listing and then sell listing. But there could be a possibility of an unlisting, not getting listed, and we have to sell that at unlisted side only. Now, for that opportunity also, we need to preempt now and see the investment we are doing, the sector opportunity and the company has to have that opportunity of 5+ years. So that tomorrow, if I'm looking at exiting anywhere, that opportunity still has to be lucrative for the new investor to come in. So that's a very, very important thematic bias we keep in perspective to safeguard our investments today. Second is on the leadership side of it. Now, on the leadership side of it, one, we are looking at the capability of the management. That management has to be capable because they've run the business. They've been able to raise various levels of funding. They've come to the stage where they want to go to the next level of raising the capital in the equity side of it. The capability of the management is one part of it. We look at it. Second is in terms of their leadership of the sector. Are they have the potential? They could be a market leader right now in the sector they operate in, or has the potential to become a market leader. Because that is what our core is, that we want to have that, we have that bias that we want to look at only those companies who either are currently the market leaders in those sectors or has the potential to be. Okay, and we'll show you some of the names in our Series 1 and Series 2, and you'll be able to make that, you'll be able to correlate why we say that, in the leadership perspective. Third bias we keep in perspective is the fundamental bias, where we are saying that the company needs to be profitable right now. That very, very important that company needs to be profitable right now when we're looking at doing it. At the same time, the leveraging has to be managed. What we want is that the money which is getting into the company is primarily being used for the growth opportunity of the company and not more for a repayment of the previous loan, because that will not allow us the growth which is being expected, in the company. So these three, thematic bias, leadership bias, and fundamental biases are very important to us when we're looking at from a perspective of investment in any company for us. These are some of the companies we had across sectors which we have made investment in Series 1, Series 2, Series 3, 3A, which have already been closed, and now we're talking about Series 3B. Like NSE, CAMS, SBI from the financial services sector. Currently, when I talk about the technology base, currently 2 new investments done in our Series 3 and 3A were a company called Daily Hunt, which is Versa Innovation, a Bangalore-based company. We've made investments here, and we made investments in Byju's. Everybody would have seen the importance of learning through the technology platform Byju's or their multi-platform. We've chosen to go ahead with Byju's here. Apple was one of this. Consumer sector perspective, Sapphire Foods got listed in November last year. We were investors in Series 1 and Series 2 with us. We came in early, at about 320 odd rupees pricing, and we've done a certain amount of equity was sold in the pre-IPO stage, about 40 odd percent, and we still have some equity with us in Series 1 and Series 2. This listing happened about 1200 odd rupees. So you can clearly see about 3 to 4x kind of a return, which has been there. NSE, as a just to give an example, we came in at about 815-20 rupees as an average price, and currently, if you've seen the NSE market, market prices anywhere between 3,300 to 3,700 in the retail side. In our books, we still have it valued at 3,000 rupees per share, and we have that investment in Series 1 and Series 2. So that is something which is still we are holding on to the investment as part of our unlisted portfolio in our Series 1 and Series 2. Ola and Ola Electric is our new investment which we have done in Series 3, 3A. And as a prospective client who's probably considering coming into Series 3B for us, which we're talking right now, this is something which we've already warehoused this investment for our clients for Series 3B. So you will have an access to Ola and Ola Electric coming in, if you choose to participate, in Series 3B for us. This slide we'll try having this slide be shared to you after this session. The marketing team will have that be sent across to you. To talk about now, this is again a very, very important slide to understand in terms of how the strategy will work. So how the life cycle, let me give you a little life cycle and then we'll see. As I said, the money investment is 1 crore is minimum investment in this fund, but you don't need to put all 1 crore immediately. 1 crore is to be taken over a period of about 18 months to about 24 months, so that is how it will be taken. 25 lakh is the current first drawdown which is there. So as and when the fund manager has the investment opportunities, he will keep raising this money in the journey of 18 to 24 months, and we'll keep asking the money. Clients will be making the payment. So over a period of next 2 years, you're actually giving the payment funds to the fund for making these investments for you. The funds continues to make investments on your behalf, and the year 4 and year 5, as we start to exit, the investments done in the series for year 1 and year 2, you will start getting the money back also. Now, in terms of how the 1 crore will happen, it's important to understand. We are saying in the unlisted side of the business, about 51 to 75% of the money will stay on the unlisted side of the business, which is the pre-IPO to late stage private equity. And we've kept a window of 25 to 49% in the listed side of the business as a range. What we've seen as an experience from our Series 1 and Series 2, close to about 65-70% of my portfolio has been on the unlisted side, and we've kept about 25-30% in the listed side of the portfolio. And when I say listed side of the portfolio, we are looking at good IPOs coming in now, okay, where you might be interested as an individual client or retail client also. And we are saying as an anchor investor and an institutional investor, we can always look at the opportunity there. So we don't want you to miss out on that opportunity. That's where we've kept that window open. What has been important as a strategy is that, targeting is up to 24 months to the IPO is the core focus. If we're looking at companies who are looking at IPOs in the next 2 years, that's the core for us to look at it. Value addition is important for us. And at the same time, we are active investors in this, so we don't want to just put the money in and then stay invested. We want to actively work with the company on a quarter-on-quarter basis to see, one is as investment is done, how the progress of the company is in this journey of about 18 to 24 months to the IPO. So that, we can, Pranav is somebody who has 20 plus years experience in the private equity side. Pranav Parekh is the fund manager who manages this fund actively. We look at from perspective, if we can get the investment to a corpus where he can have an observatory seat on the board also, so that he's actively engaged with the management of the company to see that are we on track or we are not on track on that. Okay. And we've already have the, private equity relationship already are there, and our current promoter relationship allows us to have this strategy be executed. In terms of capability, we've already shown, these are some of the examples again in Series 1 and Series 2, what we did at the unlisted side, NSE, Amber, Daily Hunt, Sapphire Foods, Byju's, Ola Electric, MetPlus. and on the listed side, Metropolis, Affle, India Mart, Gland. These are some of the companies we had invested both on the unlisted as well as on the listed side of the strategy. As I said to you, we are not limited by any specific, so-called sector. We are open to look at consumer internet, the fintech companies, the banking, financial services, insurance companies, consumer brands specialized into manufacturing. We are open to look at that, or any business services led. So we are, it's a sector. We are saying that we have the whole sectors available to us to look at from. This is not a sector specific fund. We are open to look at all, and our opportunity or the fund manager's intention is to find 12 to 15 opportunities where we are able to invest in the future perspective. Okay. Just to give you a little brief on the features perspective, I told you in the beginning is a close-ended fund, so only 999 clients are allowed to come into this strategy. This is a category 2 fund in the AIF. My Edelweiss Security Limited is the investment manager. We're looking at 1,000 crore of fund plus 1,000 crore of green shoes available. So depending upon, we're looking about a 12 to 1400 crores of fund in this. Minimum investment is 1 crore. The tenure of the fund is 5 years from the final close. We're expecting the final close to happen sometime in the month of April. From there, the 5-year cycle will start. There are 2 extensions available of 1 year each. What does it mean? Is that not for the complete 1 crore of investment, but there could be 1 or 2 investment where the fund manager believes that by doing this extension, we think we'll be able to generate some extra return. If that is so, the request is given to the clients, and if 75% of the clients agree to it, then two-thirds of the clients have agreed to it, then we are able to execute this extension and have that fund be extended for a period of 1 year, and that possibilities were twice is available with the fund. Commitment period, as I said, about 18 to 24 to 30 months is where from the final close we'll be taking the fund from the clients. So that is the time we'll have to look at getting the funds ready. Sponsor contribution, the 5 crore or 2.5%, whichever is lower, is the sponsor contribution. Currently, if you're looking at choosing to participate, 25% is the upfront money which has to be put in. There's a trustee, Vistara ITCL, who is the trustee to safeguard the interest of the clients from a security perspective is there. These is on this side of it. We'll cover the charges for the current. There is a setup fee which is there, and your relationship manager will talk to you about, on this. In terms of the fund fees, which is important, there are 3 important fees which will be charged to the client. One is the management fee. So if there's any client who's looking at investment less than 5 crore, for example, I'm just saying hypothetically 1 crore, there's a 2% of fee to be charged on a per annum basis. For the first 3 years, primarily when the commitment period is on, we'll be charging on the committed capital. So for the first 3 years, it will be charged on a 1 crore value. And year 4 and year 5, as the capital starts to be distributed back to the client, it will be charged on the reduced capital. To give you an example, let's say we in the year 4 and year 4, we are able to give you 20 lakh rupees, out of which 10 lakh was capital and 10 lakh was your return on that investment. So then the reduced capital is 90 lakhs now. The fund will start charging on 90 lakhs. And as it further goes down to 70 lakhs or 60 lakhs, it will get started charged in the year 4 and year 5. That is how it's going to be for the management fee, which will be charged on a per annum basis. Then we've kept a hurdle rate, which is a one-time fee to be charged at the end tenure of the fund, where we're saying we've kept a 10% as my pre-tax, post-expenses hurdle rate, where we'll see was the fund able to do that kind of a performance or not. If the fund is able to do a 10% plus kind of a performance, anything above 10%, whatever is above 10% will be a 20% charge on that. As a performance fee will be charged. There's no catch up on the first 10. Beyond 10%, whatever is the returns are, there will be a 20% charge on that. And this is a one time which will be charged only at end tenure of the fund as a performance fee. And then there's a third expenses, which is the fund expenses. These are actual expenses, miscellaneous expenses, which are done at the time of execution of a transaction. Could be a stamp duty charges or a legal charges or any miscellaneous expenses to be charged. Normally, they are capped at 0.25 bips, which is there. But normally what we've seen about 8 to 12 paisa, 13 paisa, which has been there as a fee, which is charged for these as a fund expenses. So these are on the charges side of it. Just wanted to make sure that everybody gets that clearly. Very, very important point, from a security and in terms of the capability of the fund. CRISIL has graded the highest possible standard, which is there in the fund management capability, has been granted by CRISIL to this fund, where they have gone ahead and reviewed the organization structure, the policy and the processes, the risk management practices we have, what allows in terms of the communication we are able to do with our clients, the track record of the performances, and the way that company. So they have gone through various parameters to go and evaluate us as a fund and given this. So this should give you, and there's a detailed report available. If you, as these guys share the presentation with you, there will be an embedded link in it, and you can go through that also, just to give you perspective in terms of that the capability why it's been evaluated by a third party, and they've seen, that this is the highest standard possible to any series available in this category. Just to quickly cover, this is my leadership team. Ashish Kher is the MD and CEO for the Edelweiss Wealth Management. Anshu Kapoor heads the Investment Management Committee, which is there. Pranav Parekh is the fund manager who's been instrumental in managing this strategy from 2017 onward. Somebody a 20+ year of experience on the private equity side, and somebody who's been instrumental in making this strategy a success for us. This is what I wanted to cover from the fund perspective. We'll have this presentation be shared across to you so that, if you have anything, Manvi, that is what I had to cover on the strategy perspective. And I'm happy to take any Q&A now from the participants,
Firstly, thank you so much, Raman, for taking out time to share your insights with our clients. We have received some of the questions from our clients, so I'll pick up the questions one by one. Meanwhile, would request the clients to post your queries in the Q&A section, if any. So, Raman, to start with the first question, can we invest less than 1 crore in AIF?
Unfortunately, no. This is a SEBI approved product. So you have to, 1 crore is the minimum investment, which is required for us to invest in the alternate investment strategy.
Okay. Moving further to next question. What is the taxation on this product?
All right. So good question. I think it's important to understand. I think I messed that out. So what is important to understand from a client perspective on the taxation, that there are 4 types of incomes which you will have in this, which is primarily most part of the income will fall in the long-term capital gains, because we are buying unlisted and selling enlisted. So most part of the income will fall part of the long-term capital gain, but there could be some short-term capital gains as well. If I'm buying and selling in less than 12 months on the listed side of it, or a 24-month unlisted side of it. And then there could be some dividend income or income from other sources. And how, I think there's a question I see, from Preeti, because we're paying in tranches, how does the question is, since you've been paying back to client in tranches, how does the client file taxes? Let's say example, 1 crore invested and you give them 20 lakhs of this 10 is profit. So Preeti, as a fund, every year we give a form 64C to our clients, which will very clearly state, what is the income which are there, either paid or accrued to you also, but not paid. And we will quarterly, there's an advance tax letter. This is also shared with our clients so that they can pay their taxes in time. And at the end of the file, for the final filing of your returns, we give a form 64C along with a profit and loss statement account, where we tell you what has been, if there is any income for you for which you need to go ahead and make any taxes, which category it is there, because at the fund level, only 10% of TDS is deducted. Rest all income across various heads is given to you black and white, so that you can file your returns accordingly. I hope that answered your question. So we can move to the next question, Manvi.
Yeah. So the next question is, what is the allocation percentage that we are allocating in companies at fund size level?
Okay. So very good question again. As I said, that we are ideally looking at, 12 to 15 companies to be part of the portfolio. So if you look at it from a crore perspective, what we're saying is my allocation will be in a company will be between 4-5% to about 10%. And as a fund, what we believe is that we don't look at, to safeguard the interest of the clients, we don't go beyond 10% in any company. So between a 4-5 lakhs to 10 lakh is what will get allocated for the individual investor perspective in each company.
Next question is, which are the parameters that you look at while selecting the companies to invest in?
So as I said in my presentation on the 3 fundamental approaches which we have, that the growth of the sector is important, because I am looking at emerging sectors and I'm looking at the sector has to have a growth opportunity of 5+ years. That is first. Second is on the leadership side, which is the capability of the current management to take it to the next level. And the second part on leadership, as I said, was that that they are either the market leaders of their current sector or has the potential to become a market leader. And we look at those elements, that how the sector is performing, who are your competition. We do the detailed competition analysis in that. And then the third part is on the profitability. The company needs to be profitable right now with low leverage. So these are some of the parameters the investment management team evaluates while going through the opportunities which are available for investment.
Next question is, what is the CAGR percentage of your last 1-to-1 series?
Okay, here, because what is important to understand, because we are taking the money from the clients in a tranches form, where the money is to be paid over a period of 18 to 24 months, and year 4 and year 5 is when you start getting money. So if you actually look at your 1 crore is actually with the fund only for about 3 years or 3 years, 1 month or 1 quarter. Okay, that's the only mean time, where actually full 1 crore is invested with the fund. Pre and post, the money was either coming to the fund or going back to you. So here we don't have the CAGR, we have the IRR returns. And as I said, there's a 23% IRR for our series 1, which was in November of 17 onwards, closing in this year, May. Series 2 is at about 40% plus. Series 3 is a recently, we started this about 10 months back only, and is about 16-17% right now of the investments we have done recently. But too early to say anything on that right now, because the journey of 4.5, 5 years is still there on that.
Okay. So Raman, next question is from Mr. Vinay. Is there any pre-exit option available in case of any emergency?
So thank you, Mr. Vineet, for asking this question. Normally, this part of allocation is an illiquid investment. Okay, but in certain situations we have seen, especially we saw that in the COVID time, there were requests on that, and it all depends upon if in the secondary market we are able to support you in finding a buyer who's ready to come in at that current pricing and invest and take over because these are close-ended funds. So it can be supported, but it's not a promise. It all depends upon availability of a buyer to come in at that point of time. So in case of an urgency, your relationship manager will make the best effort basis support, and you can also help us, finding a buyer, or we will also try looking at our current investors, and if somebody wants to invest, we can look at it. But you should look at from an allocation perspective, look at allocating that part of it, which is more illiquid investment, and you're okay to continue to invest for a 5-year period.
Okay. Next question is, could you please share the trustee details?
Sure. So Vistara IPCL, all the details are mentioned. So if you are looking at finding more details, so Vistara IPCL is the person who is appointed as a trustee, and the trustee's role is to ensure to safeguard the investments and the interest of all our clients. You should know that Edelweiss management team is just the investment manager. Tomorrow, and the role of a trustee is that tomorrow, if 75% of the investors in a series believe that Edelweiss investment management team is not able to do justice to their investments, they can go to approach the trustee, and trustee has the right to actually remove us as an investment manager, and in consultation with the clients, can appoint somebody else as an investment manager. So all that safeguard features are there, and if you are looking at in future to looking at investing in this, I would request you to ask for the private placement memorandum agreement, which is there, which has all the details listed down to you, and you should go through that, so that you are clear in terms of, some of us might be looking at, some of us might already be investors in the alternate strategy, but if you're somebody who is either somebody already invested in AIF, or somebody looking newly, to add this as part of your portfolio, please go through the private placement memorandum agreement, and it'll have all the details available for you. And you can reach out to your relationship manager. They should be able to support you in that.
Okay. Raman, we have some more questions coming in. Next question is, can we have any tie-up deal with LIC in listed or unlisted category?
No, so here I know the interest people have currently in the LIC IPO, which is coming in, and there was some news I think about yesterday also. So what is important to understand is that at a fund level, they might be evaluating various deals. Okay, what is important to understand from your perspective is to get 12 to 15 good deals at right valuation. Okay, without naming some of the deals in the last year, we evaluated all the deals which came in the IPO. Okay, but did we enter? The answer is no, because what is important to see, because what is important is how will the fund manager be able to generate returns for you is when they are able to enter into a good company which has the future prospect very well, the sector is growing, and they're able to enter at the right valuation. So if the valuation to the fund manager believes that and I don't know whether they are evaluating LSE right now or not, but I'm sure they will be looking into it. And if you think that the valuation is right, they might look at it entering at a fund level, which is there, and we will get to know only that in the future once we have more clarity on that.
Okay. So Raman, we have answered almost all the questions, and the ones which are skipped are the repetitive ones. So with this, we can end our webinar. Are there any closing comments from your side?
Sure. So first, thank you for joining in. Thank you for being part of this session. I hope whatever I covered gave you a perspective of the strategy. If you choose to look at it, why you should look at it is that it creates balance for your portfolio is one important point which I always tell my clients, that if you are looking at allocating money to this, is consider as a separate asset class. You can buy unlisted stocks in the retail level also, but one challenge which is there, nothing wrong with that, it's an opportunity which is available, many of us exercise that opportunity. Just keep in perspective here, the focus is very, very clear. We're looking at those companies which are coming into the IPO in next 2 years, and here the information available to the fund manager to evaluate what is right valuation for somebody to come in, and the journey of the next 2 years. Because as a fund manager, I said we are actively engaging with those companies. Making investment is one part of the journey. Continue managing that investment for next about 18 to 24 to 30 months is very, very important part of the journey. And we've seen in that what is that journey allows you to see that investment made 2 years back is on the right track or not, so that if there's any action or reaction to be done, we are not waiting for market news to happen. So that is the part of the strategy which is there. One part I think just you should know, as a client, you have an access to the fund manager quarterly. There's an update call which happens with Pranav Parekh, where if you are the investor in the series, you are invited to be participating in that, and you get to have access, get to understand his perspective of what he's evaluating currently in the market. If you have any questions directly about any strategy or investments he's done in the past or he's looking at it, you will be able to do that access along with the rest of the communication which is available to the client. So that is my request to all of you. You should reach out to your relationship managers, and if you have any further questions, we will be glad to come back and support you and share more details if required. So thank you everyone for joining in. Please stay safe, wear a mask, take care of your family, and all the very best.
Once again, thank you so much, Raman. We just received a few more questions asking whom to approach for investing in this fund. So as informed by our speaker, you can connect with your respective relationship manager and they will guide you for it. We are also receiving questions inquiring about webinar recordings. So participants, you can connect with your respective relationship manager asking for the recording link, and the same will be shared with you on your registered email ID. If you have any more query or feedback, kindly drop us an email on helpdesk@edelweiss.in and we will reply back to you. Thank you everyone for joining us. We hope the webinar was insightful for all, and we look forward to see your active participation in our upcoming webinars as well. Stay safe and have a wonderful weekend.
Thank you everyone. Take care. Bye-bye.